Hi, this is Fred. I'm a hedge fund manager running a long-short hedge fund focusing on global technology stocks. Three key risks about hedge fund. These are the key three risks that come to my mind. The first one is overconfident. I found that to be a good trader or a good fund manager, to some extent we need to have an independent view. But that independent view sometimes will translate into overconfidence. So how to switch from how to define whether you are really making a good decision but suffering a short-term loss, how to insist on holding the position and get so it is quite challenging to judge whether you need to cut loss or you need to. But sometimes we always need to remind ourselves to avoid to fall into this trap overconfidence. The second one is the risk management, especially for the the loss cutting system, especially when the bet size is big. For a small position, then it depends case by case. For big position, let's say you have a 10% position of a stock, or there's a big position, a substantial position of your portfolio. When that stock share price goes down, when you are going long, or when it spike up, when you are short selling the stock, then you are suffering from that loss, and that loss will be substantial and very critical to your portfolio performance. In that case, risk management it will be key. As long or when the stock is liquidity is limited, then will be another big issue. So I think risk management is really important. It's not just a textbook material. We really that will differentiate a good and bad trader, or a good fund manager or a bad fund manager. Because usually when we are on a bull market, a beta market, amplifying the momentum, then it is quite easy to make money. When it is a down market, a bear market, it actually challenges the risk management ability. The third point is style drift, which is quite common in the hedge fund industry. Style drift means that the hedge fund manager, when they run the portfolio, they usually have their expertise in certain area. For example, they are very good in certain sector, for consumer sector, or the technology sector, or the blah blah blah, or they specialize in country. For example, they specialize in U.S. market, you specialize in Taiwan market, Korea market, or they specialize in asset class. For example, they specialize in commodity, or gold, or oil, blah blah blah. When those fund manager become overconfident, or they face some obstacle, they try to diversify, or they try to look for some area to invest where they are not really got enough experience, and or the team itself is not experienced in that area. That will create a big problem. Style drift is very critical and very dangerous for a fund manager. So, but at the same time, for a fund manager to diversify his risk, he need to learn something new, to explore a new area. So there's some sort of balance between the style drift and the expansion of the coverage. But to some extent, I think risk management is more important, to focus on what we are really good at. But a lot of people will argue that if the sector or the area that this fund manager or the team, that sector is not doing good, is in a downtrend, or is it's not investable, or no more actionable idea can while conviction idea can can be generated. So in that sense, they will try to expand new area, and which will sometimes will fall into style drift, which is very, very dangerous. I speak. I'm gonna try. Forgive me to remind once again. Style drift is very, very important. Okay, thank you.